Good afternoon and welcome to our Academy Forum. I am Michaela Johns, one of the directors at Hopper Williams and Bell, and head up the Academy Schools team. So we're at the start of the summer term in the run-up to external audit time. So I hope everybody is feeling refreshed from their half-term breaks that you managed to get away on. So some practical points before we start today's Academy Forum. We'd like you, if you could, put any questions you have in the chat box and we will answer them as we progress or at the end of the session. You will see that your cameras and microphones are switched off unless you are presenting today. And the presenters will switch on their cameras as and when they are speaking, so you have a bit of a change just from the slides. But I'm controlling the IT today, so anything could happen. We will send you the slides and the documents in the follow-up email next week, so you can share with your teams and your trustees if you want to. The webinar is also being recorded and will be available on YouTube. And again, we will send you the link. So on to the agenda for today. First of all, James Flood will talk you through the changes we saw in the latest Academy Accounts Direction. Alan Davies will cover the main areas to consider for the BFR, which many of you will be working on now. Gary will cover feedback from the most recent ESFA External Auditors Forum, which was held in May. And then we are delighted to have two speakers, Jenny Fram and Annabelle Huffer from Eddisons. Many of you will know their firm because it's well known in the sector. They will be covering points on your estate management, covering such things from valuations to the green agenda. I will then summarise points from internal scrutiny assignments that have been undertaken to give you a few ideas and tips. And then Alan will pick up areas on the teachers' pension scheme audits. We are then pleased to have with us another external speaker, Kirsteen from Trethowans. Many of you will know of her when she was at Blake's, and she will talk you through governance points to consider. And then finally, Matt will look at investments and the connected policies. So quite a lot to get through and today. So I'll make a start, first of all, with James Flood.
Thank you, Michaela. Good afternoon, everybody. So some very exciting news. We've got the latest version of the Academy's Accounts Direction, which has recently come out, and that covers the current academic and financial year, which is due to end at the end of August. I'm sure a majority of you are aware of the Academy's Accounts Direction, or I'll refer to it as the AAD, but for those that aren't quite so certain, so this is a document that provides guidance for both the trusts and for us as auditors in terms of the requirements in preparing and submitting the annual financial statements. So I'm pleased to say that there haven't been any major changes this year, but I will go through a few of the new points that have been added, as well as a few areas that the ESFA have suggested could be dealt with a little better. So first of all, there have been some points added in respect of the numbers parts of the financial statements to clarify the treatment and disclosure requirements in some areas. So the first of these is the treatment of loans, and I think, to be honest with you, this is a fairly obvious one, but it's a requirement to split the loans based on when the liabilities are due. So any payments due within 12 months are shown as short-term creditors, and anything due in more than a year are presented as long-term creditors. I think I'd say that for our clients, this is something that we've always applied, and it's fairly simple accounting practice really, but it has been included nonetheless. The second addition relating to financial statements is some further emphasis relating to the need to disclose any material sources of income separately in the notes to the accounts. But on the other side of that, any non-material sources of income can be grouped together. Again, this is something that we would usually do as standard anyway, but it's always helpful when sort of you as the academy split out the different income sources on your trial balances, which I think, you know, the majority of you, that is the case, so that's great. And then the other change surrounding financial statements is some guidance in that the teaching assistant salaries and costs should be assigned as support costs in the expenditure notes, as aside from direct costs. And the overriding rule within the AAD is that any staff with no day-to-day teaching responsibilities should be included in administrative and support costs. So that's the wording that they use in the direction this time. So it may result in a little bit of reclassification of expenditure, but it won't have any impact on sort of the final position. So that's it in terms of the numbers part, but then it does go on to extend the guidance in other areas of disclosure, mainly actually in the trustees report. So what first part of this, so guidance has been added as to the expectation for academies to have interim arrangements. So in the event of the departure of or long-term absence of your signatories. So this mainly really refers to the accounting officer. So where your accounting officer is absent for whatever reason, it's expected that the board should decide what interim arrangements are required, because you're expected to have an accounting officer in place at all times. So I don't know, for example, if you had a policy in place where one of the deputies would stand in as the accounting officer, just documenting those points really. And I think as part of that as well, so if you had an accounting officer that leaves between the end of the financial year and the point at which the accounts are signed, then whoever is going to be signing the accounts as the accounting officer needs to be sufficiently briefed with details of the financial information so that they can sort of really have a clear picture before they're signing off any documents. So I think the underlying point here is if you do not already have a plan in place, a contingency plan in place, then this is something that needs to be considered and documented. There's also a section in the accounts direction which sets out some areas which have already been included within the document, but where academies and auditors are not always applying them as well as could be. So a few examples of these. Say, one of the points that the ESFA have commented on is that some of the wording in the trustees report is often just copied and pasted from the previous year or from the model accounts, and therefore sometimes found to be sort of out of date or not necessarily relevant to the academy. There were also instances noted where the trustees report wording and the numbers within it didn't tie back to the financial information in the supporting sort of pages of the accounts. As with the earlier points, these are things that we all check ourselves when we are preparing accounts, but clearly this isn't the case throughout the sector. There's also a few areas where compliance with the disclosure requirements are noted as being possible for improvement. And again, just to run through a few of these briefly. So they have emphasised the need to include details of any subsidiaries, if you have any, when setting out the organisational structure in the trustees report. Second one here, so in the governance statement, ensuring that there is adequate information to set out the governance framework of the Audit and Risk Committee, rather than just listing its members. Then the next one, so describing the processes in place to manage any conflict of interest that have been identified. So rather than just having related parties noted on declaration of interest forms, delving a little bit deeper into those and any possible sort of conflicts that may arise and how those have been safeguarded. They also mention the need to include a note as to why you as an academy choose a particular option of delivering internal scrutiny. as part of describing why it has resulted in useful outcomes for the Academy. And then the last point here on the disclosures is the trustees' remuneration note. So the need to actually include the name of the staff member who is also a trustee, rather than just a line saying staff trustees remuneration with a total figure. So the SFA have sort of noticed that some academies are, not being clear on who the staff trustee is, and obviously there's reasons why you wouldn't want to disclose that, but ultimately it's a must in the handbook. The final change that I'd like to quickly mention to you on this year's accounts direction is surrounding the school building safety risk, and in particular content that's needed for the trustees report in this area. So there's some new guidance to say that the principal risks and uncertainty section in the trustees report should include a note relating to school buildings and what steps the trustees are taking to ensure that they are, well maintained and safe. Aside from that, the overall value for money statement that's included should also have notes to explain that it considers the spend on estates to ensure that it sort of encompasses safety and maintenance of the premises. And then the final point, relating to the estates is that the statement on regularity, propriety and compliance should include estate safety and management as well as part of that. So generally, I think we are going to see a lot more focus on estate management and moving into the green areas and that sort of thing. So it seems to be an overriding trend at the moment. So all of these sort of changes that I've gone through, we have summarised in a fact sheet that we recently prepared and circulated. So if you haven't got a copy of that and you would like one, please let us know, and we'll happily send it over to you. So yeah, I believe I'm now going to pass you over to Alan Davies to run through the budget forecast returns with you.
Thanks very much, James, and good afternoon, everyone. So, as it's the time of year when academies are starting to draft their budgets for the forthcoming financial year, we thought it would be a good time to provide an overview of the budget forecast return process and a quick update on any changes from the previous year. So this year's submission deadline is the 31st of August, which is slightly later than previous years. It used to be sort of towards the end of July, so it's a little bit of extra time this year, which is good. The BFR online form is now live and available for submission. And just a quick note, the ESFA have a 1-hour Teams webinar next week on Tuesday the 13th of June at 10 AM. So if you'd like to attend that, details are on the ESFA Budget Forecast Return webpage. So firstly, having a look at the structure of the form, really there's only superficial changes this year, although the ESFA have indicated that they will be pre-populating the opening balances using data from last year's accounts return, which will hopefully be helpful. As in previous years, the detailed breakdown of income and expenditure covers the 3 years ended 31st of August 22, 23 and 24. Each of these years is subdivided into 2 periods, the 7 months to March and the 5 months to August. Actual results from last year should be consistent with the accounts return for August 22 and also of last year's budget forecast return for the element relating to the 7 months to March 22. Looking at the current year, figures should be based on actuals up to and including March 23, with a forecast for the remaining 5 months of the year. This forecast can be actually also partly based on actuals as far as the information is available, with an estimate just for the remaining months from when you're preparing the form up until the year end. As in the previous year, the return also includes summary forecasts for the 2024, 25 and 26 financial years. 2024 will be automatically summarised from the detailed forecast already entered for that year. So, yeah, very few changes. Of course, the key part of any forecast is the underlying assumptions. With the current uncertainty relating to staff pay increases, energy costs, price rises, it's more challenging than ever to set assumptions. Best practice is that the key assumptions in your budget should be clearly documented, kept under review as more information becomes available, and considered by the Board of Trustees as part of their review of the overall budget. The key assumption for any academy forecast is the number of students or pupils on roll. It's important to be realistic with projections for future years and to take into account any demographic advice that's provided from the local authority. Just as an overview, the government have published high-level projections which indicate an ongoing decline in numbers at primary and nursery schools and a peak in secondary and special school numbers in 2024, followed then also by a gradual decline. Of course, there'll obviously be considerable local variations on that. Include other income in the budget if it's reasonably likely to be received. For example, the sports premium will continue for the 24 and 25 financial years. In addition, next year, mainstream schools will also be allocated funding through the Mainstream Schools Additional Grant, which is in addition to allocations through the National Funding Formula, and that's been introduced as part of measures to try and support pressures on costs. For the 2024 financial year, the school's supplementary grant will be rolled into the National Funding Formula. The factor values will also increase to give minimum per pupil funding levels of £4,405 at primary level and £5,715 for secondaries. Looking a bit further ahead, that new Mainstream Schools Additional Grant is likely to end up going into the National Funding Formula. Looking at the future years, the Association of School and College Leaders have published some useful guidance on budgeting in general, and as part of that, they've suggested that applying a 2.5% increase in revenue income per pupil for year 2 of the forecast would be appropriate, and that 2.5% includes the new Mainstream Schools Additional Grant. So looking ahead to year 3, that year is actually outside of the government's current spending review period, so it's anyone's guess as to what will happen with funding. However, the autumn statement mentioned a 1% increase in spending in real terms, so it might be best to keep any expected increase to a fairly low level. Moving on to expenditure, the main assumptions are of course in relation to staff costs, being the main element of expenditure. Firstly, looking at teaching pay, we're expecting that teachers will receive a one-off payment of £1,000 for the current academic year, which will be fully funded. For next year, teachers and leaders have been offered an average pay rise of 4.5%, and the starting salary for new teachers will rise to £30,000. While there may be some additional funding for these increases, the DfE consider that an average pay rise of 4% is now affordable for schools because energy costs are forecast to fall at a faster rate than what was previously expected. So I don't know, but I'll let you be the judge of whether or not that is a fair assessment. So moving on to support staff, the pay offer of a £1,925 increase to all pay scales is still not confirmed, but it's a good basis for setting the budget. And that increase equates to an increase of between 4% for the higher bands on the scale and up to 9% for the lowest band. Looking further ahead, there isn't clear guidance on increases to teaching and non-teaching pay, but the ASCL have suggested using inflationary increases for the future years. Considering employers' pensions, the teachers' pension contribution is expected to remain at 23.68%, but LGPS contributions will vary by local authority. The valuation for the Hampshire Pension Fund was published recently. In that valuation, we saw that improved investment returns led to a reduction of 1% in the employer contribution, which has been set at 17.9% pensionable pay for the next 3 years. If you're in a different local authority area and you want to find out more about the future years for your relevant local authority scheme, please contact the scheme actuary and they'll be able to advise you. So moving on to non-staff costs, utilities are of course a very significant expense. Increases in energy costs will vary according to individual contract terms, so check with your provider. Locally, we've heard that Wiltshire schools have been advised to budget for increases of 50% for oil and 11% for electricity. The government's energy bills discount scheme will continue support for businesses until March 24, but at a reduced rate, which is subject to a wholesale price threshold. So we suggest you check whether or not your academy will remain in scope. Just one extra point on water costs. We are aware of schools which have saved money by conducting water audits to identify overcharges that have been levied in previous years. So that might be something that's worth consideration. And a final point on utilities. A recent DfE bulletin mentioned that some lease providers are approaching academies to offer reduced energy costs through LED lighting, solar panels, and other sustainable initiatives, which can offer significant benefits and savings. However, the bulletin highlighted that trusts need to review and decide whether the schemes are categorised as finance leases for accounting purposes, which would require ESFA approval. So just something to watch out for there. Looking at general costs, inflation is projected to fall rapidly during 2023 and 24. The latest Treasury projections for CPI inflation are 7%, 3% and 2% for 2024, 25 and 26 respectively. So finally, there's a little bit of good budgeting news there. So I hope that's a helpful summary. Please let me know if you've got any questions or need any help with your academy's budget forecast return for this year. I'm now going to hand you over to Gary, who's going to give some feedback on last month's ESFA External Auditors Forum.
Thanks, Alan, and good afternoon, everybody. So I'll just touch on briefly what the External Auditors Forum before I get on to the what was actually discussed at the forum. So the External Auditors Forum, generally we're meeting about every 3 months or so, and it's a chance for auditors to feedback any concerns they're having, anything they want to ask ESFA, any concerns clients are having as well. So if you do have any concerns or anything you want us to approach the ESFA on, generally related to audit, then please do send through any sort of questions to me. I'll be happy to address them if it's of adequate concern. So we saw in 2022 that they weren't holding the forum at all, just due to structural changes at the ESFA. We're now starting to have the forums again on a more regular basis. So this was the second one we've had in 2023. The first one was about 65 auditors attended. This one's about 90. So we're starting to gather pace again. So hopefully we can keep them up, and we can tick off some relevant issues as we go along. So the first thing they spoke about was the AAD. Now James has been through the changes. I'm not going to go through those changes again. What they did ask really was whether there's any feedback from many of the auditors. There wasn't much feedback because there hasn't been any changes. The one thing that the SFA did mention though was, and James touched on it, to do with the building safety and health and safety, and that was really that the Department for Education, their risk monitoring, had seen some instances of late where this wasn't being properly applied, and it was of adequate concern that they felt they needed to readdress it, and hence a refocus on this in the AAD. But generally, other than that, there wasn't a lot of questions from the auditors' audience. We've spoken previously about the LGPS. This year, more than any year, was probably one of the hardest years to audit the LGPS pension scheme. And it's a subject which is going to rumble on, I think, for quite some time. One of the attendees at the forum was from the ICAW, so our regulatory body, and really the only update they could give us at this stage was that they formed some working groups to look at this. So we really think this is just the tip of the iceberg. We think this, hopefully we can get some more guidance in this area going forward. The main concern from the audience really was to do with how do auditors audit pension scheme assets. It's quite a difficult area, especially when we're not experts in pension schemes. The actuaries are. And also inconsistencies over how auditors are treating pension scheme surpluses and accounts. So some might recognise it, some might take the view, well, actually, it shouldn't be recognised. So there's some inconsistencies there. So it's really watch this space, but I don't think it's going to be any time soon before a consensus is reached on that. The third point was finance and operating leases. Alan just touched on it briefly there on his slides. Probably the most relevant point to the audience today really was the audience really reported back that there'd been quite a few sort of fairly painful, awkward discussions between auditors and trustees, leading to qualified audit reports where there was a disagreement about whether the lease was an operating lease or a finance lease. So the upshot of it is that make sure you get that reviewed well in advance of your audit. The SFA were particularly concerned because of the number of approaches that trusts have been experiencing, especially with things like energy efficient lighting, those sorts of areas, where operating leases are being, finance leases are being badged as operating leases. So they really want trustees to look at trusts and trustees to look at this closely. They issued an update on the 17th of May, just reminding trustees of their responsibilities here, with a link to the good practice guide for finance leases and operating leases. There was a question that came from the audience, which was to do with whether they could put in place a similar process to related party disclosures and approval of related party transactions, whereby a trust might upload their lease to the SFA and they could make a call on it, but they weren't keen on that. They very much feel like that's a local decision, and they should speak to their auditors or accountants as they see fit on that. The final thing they mentioned as well was they were looking in 2022 at having a list of exempt assets, which could be either a finance lease or an operating lease. That list got quite far down the road, but they pulled that at the last minute. And to their knowledge, there's no imminent sort of re-raising of that point. So it's not off the agenda, but it's not going to be published anytime soon. And the final point, we've just asked about the trust handbook. So the aspiration is the trust handbook will come out end of June. However, more likely the trust handbook will probably be in maybe 1 or 2 weeks after the end of June, so early July. So as soon as that's released, we'll do our normal fact sheet on what the changes are in the trust handbook. If you've got any questions, please do pop them in the chat box. If not, I'll hand over to Jenny at Eddisons.
Hello, everybody. Really nice to join you this morning. Or this afternoon even it is now. Just going to have a really quick chat with you today about various aspects of estates, but as Michaela said, we're going to do a bit of focus on kind of valuations and the green agenda and that kind of thing, really. If you can just move me on to the next slide, that would be great. So Eddisons are multidisciplinary property consultancy. We're based all over the UK, but we do have offices down on the south coast and do quite a lot of work with the education sector on the south coast. It's good to see some familiar names on the attendee list today, so that's quite nice. I'm not going to read out all the slides today, and neither is Annabelle. We're just going to go through in kind of high level detail, and then obviously you'll have the slides anyway that you can have a look at, and the recordings, etc. And we're happy to chat through with anybody that wants to talk to us offline as well. So just to introduce myself, I'm Jenny Fram. I'm the head of business development for Eddisons, and I kind of look after Academy Trust across the whole of the UK. I kind of work as a bit of a buffer in between the surveyors and the Academy Trusts, can kind of break things down into a bit more understandable, less jargony type of language, I suppose. And then Annabelle works down on our South Coast office in Fareham. I'll let her introduce herself.
Hi, so I'm Annabelle Huffer. I'm a graduate building surveyor, having finished my degree in February this year. I've got 4 years of experience in the building surveying industry, and I've managed all sorts of different projects through my time. Quite a keen interest in the education sector as well, and it's something that the Eddisons are quite passionate about. So next slide, please, Michaela. So what does it mean to work with Eddisons? So we've got a growing team across national coverage. We also have offices down on the South Coast in Fareham, where I'm based. And we've also got offices on the Isle of Wight, Bournemouth, and in Hailsham as well. They're our most local offices to Hampshire. We've provided building surveying coverage and also valuation coverage across all these offices. We deliver practical and cost-effective solutions to schools and academies, which add measurable value to your estates. We've got a large team of RICS chartered surveyors, being both building surveyors and registered valuers as well. And we are all enhanced DBS checked, and we've got extensive experience across lots of different sectors, as well as within education. We often provide a single point of contact for all projects. So as our clients, you've got continuity of care for people that are managing your projects. And then also we are framework members for the Crown Commercial Services Estates Management, and also for ESPO framework for Property, Building and Infrastructure Advice and Management Services. On to the next slide, please. So why bother about estates? So being a strong trust is beyond just providing education and the financial side of it. It also involves the buildings that you work in every day, and that your students and pupils need to use. And as part of that, evidence of good use and care of the estate is all part of it. So the good estate management for schools, otherwise known as GEMS, is really about warm, safe and compliant educational environments for your pupils and students. And as part of that, there's the statutory compliance side of it with asbestos management, fire risk assessments and the day-to-day sort of running of it. The Department for Education places a responsibility on you as the Academy Trust to have good knowledge of your properties and the compliance of that. The self-assessment tool helps to manage this, and it will show up areas where improvements are required and also where you're meeting various areas. And it will also help to create a vision so you can strategize and plan for the future. And all of this can be quite time consuming to compile all the information and make sure that you've got everything that you need. And that's where we can come in, and we've got contacts with different professionals for different areas that we can help to bring in to help with this. Next slide, thank you.
So back to me now. Basically, there's a number of checkpoints. Across your estate, whether you're one school, whether you're many schools, you need to be confident that your premises, as Annabelle said, are safe, and you're following GEMS as a method of ensuring everything's in place and that you know what's coming over the horizon. There's kind of 10 checks that we set out that you can use as kind of tests to make sure that you're kind of fitting in with all of that side of things. First one being effective management. Is there a strategic approach that ensures your organisational processes and policies are in place? In turn, that keeps your estate safe. Who's responsible? You need to identify and equip those people who are responsible for safety and staff of pupils, for maintaining land, for premises, for equipment, and for making decisions about investments in your estate and prioritising maintenance. Once you know who's responsible, do they have the skills? Do they have the capacity and the experience to do what's required? Buying in external expertise is considered an investment in these things. Sometimes it can save you money, save you time, and obviously save you effort as well. Good estates management should give you safe, well-maintained premises. Amongst other things, producing an asset management plan for the estate. It helps you plan and manage and deliver the maintenance works and improvements that are highlighted. The condition of your estates is massively important. It helps you make clear decisions about maintenance needs now, in the future, informs your capital spending and your wider property issues. Are you meeting your legal responsibilities? You know, health and safety regulations are massively all-encompassing. It's vital that everyone's aware of and performs to these roles. Examples in schools are things like asbestos and fire safety, but obviously delivery of maintenance of capital works is really, really important as well. The health and safety involved in that. People really, really need to be aware of these duties. What do you do in emergencies, such as damage or disruption to the use of your premises? There should be plans in place for this, what to do when it arises, you know, clear decision making at times that can be really high stress. Funding is a very thorny issue, as everybody knows. There's sometimes alternative forms of funding. Obviously, you've got your GAG funding, you've got your SCA, you've got SIF and things like that. But it's important to be aware of what other funding's available, or to know somebody that is aware of what funding's available and can help you with it. Budgeting, correct budgeting. Are you spending wisely on your estate? Obviously, there's an enormous strain on budgets, and very much towards kind of staffing costs and things like that as much as anything else. But it's important to ensure you've got enough allocated for capital and for maintenance projects every year. Obviously, that ties in with your condition survey, because the condition survey will help you prioritise the expenditure and make sure you achieve value for money. Finally, can you become more effective in your expenditure? Having professional support and advice ensures that when work's procured, it's appropriate and that all companies are offering prices that are actually pricing the same thing. Otherwise, schools can be frequently in contravention inadvertently with their procurement regulations. If we can go on to the next slide, please. So the other thing to think about is due diligence. The definition of due diligence is up there: comprehensive appraisal of a business undertaken by a prospective buyer, especially to establish its assets and liabilities and evaluate its commercial potential. Due diligence is something that you need to undertake if you are looking at taking on new schools into your trust, if you're becoming, you're moving into a trust, if you're academising, all of that kind of thing. There's various things to understand as part of that. Valuations is a really important thing to undertake as part of your due diligence. You need to have your Red Book valuation to establish the value of school premises and land when moving into a trust. It's also used for your audit every year, as you'll know. You don't necessarily need that valuation to take place every year, but do you want to wait until your auditor says, oh, you need Red Book valuations on all of the schools in your trust, and we want them in 3 weeks' time, please? It's a good idea to kind of have an idea of when you're likely to be asked to have your valuations updated, so that you know that you've got them ready at hand when the auditors ask for them. And as it says there, you should really look at reviewing those once every 3 to 5 years, or after any significant physical changes in the property. And then condition surveys, if you're bringing new school into your trust, having a condition survey, a full condition survey conducted by RICS chartered surveyors is vital. It establishes a condition. It allows the trust to negotiate with a local authority or another trust if they're looking to bring a school in. If they can see that there are issues within that, within the estates of that school, then that's a negotiating point to, who does that, who pays for it, all of that kind of thing. Relying on CDC surveys, local authority surveys, is not advised, because obviously they're not really as in-depth as a full condition survey will be. And then obviously thinking about funding opportunities and where you might be able to get hold of those as you bring in schools into your trust, or as you move into being part of a multi-academy trust. Next slide, please.
So creating an effective estate strategy, it sort of encompasses everything that Jenny has just spoken about. But the delivery and implementation of it, primarily the PPM or the Planned Preventative Maintenance Schedule, really helps to set out the current condition of your buildings, and then it helps to look into the future and prioritises work. So they generally are split out into sort of 1 year, 2 year, within up to 10 years, and part of that will be the budget costs for that, so you can budget effectively and you know exactly where you're going to be spending the money and what might be needed, so you can have a look and make sure that you do the urgent works first. The Master Estate Planner, this is a dynamic document which requires updating as projects reach completion and as different areas of work are completed across the estate. And all of this is part of your good estate management strategy, with all the statutory compliance and meeting the responsibilities put on you by the Department for Education. It will also look at longer term proposals and goals so that you can look at effective investment and cost strategy and budgeting into the future for your buildings to make sure you can meet where you would like your trust to be. And then finally also decarbonisation. This is a big part of a lot of trusts' thoughts now, and it's only going to get more as we move into the future. Where are the focal points for decarbonisation? Where can your properties be improved by this? And all the advice and planning aspect of this, quite often you need sort of an external advisor for this. It can be quite complex, and it's looking at the best cost-effective way of doing it to make sure that you get the most return out of your investments for it. Next slide.
So in terms of sustainability and decarbonisation, obviously we're all carrying concerns over the price of energy, and I know that schools more than any are really, really concerned about the amount of money that they're spending at the moment on their energy cost. There's some easy wins available, you know, in terms of kind of the actual estates themselves. Pitch roof lofts, you know, is it insulated well? You wouldn't let your house have no insulation, so you know, make sure you've got insulation in your lofts. Things like that are the easy wins. Fluorescent lights for LED, you know, it'll save you around 85% on the electricity costs for swapping out for LED. So take that opportunity. You know, as we know, everybody forgets to turn lights out when they leave rooms and things like that. Those are the types of things that can really benefit from having LED lighting. It's a figure that's been bandied around quite a lot at the moment, so you may have heard this, but schools use around 60% of their energy when the children aren't there. So that's kind of, you know, there's a lot to look at there in terms of how you can reduce that. You know, if you're a secondary school with an annual bill of about 140k, you know, there's a huge amount of money to save. It's about 40% of your electricity. So it's worth asking your utility company for half-hourly billing, and then you can start getting used to seeing where power is used and when, and then you can start targeting the savings and things like that. Look at the amount and type of energy that you're using. You know, all schools and multi-academy trusts should have a climate action plan by 2025 and a nominated sustainability lead. You know, to be effective in that, you need to have a real understanding of the state of the buildings that you're working in and the decarbonisation plan going forward for that. Obviously, there's lots of things available. There's not enough things available, but there are options available. There is funding available. The Low Carbon Skills Fund is there to help you have decarbonisation plans written for your schools. It can help you with project planning for actual decarbonisation works. What it does is it pays for consultants like ourselves to come in and write those plans for you so that you're not having to fund that. It's probably one of the only government funds that doesn't have any match funding involved in it. So every single penny of it is, if you're successful, is provided by SALIX funding. The Public Sector Decarbonisation Scheme, that opens this autumn. That's for where you have identified projects that potentially you would like to get funding for. It does have some match funding involved, but it reduces the amount of funding that you need to put in yourselves by an enormous amount. And then obviously in December last year, the additional energy efficiency funding that the government gave to schools, as far as we know, it's a one-off, as far as we know, but but it's never say never. Hopefully there will be some more. We just have to wait and see. That was unannounced, so you know, there may be more unannounced funding opportunities. But what can you do now to help with your decarbonisation? Invest in your decarbonisation plans is a key thing. You need to know where you are with your estates and what your path towards net zero is. So that decarbonisation plan will help you with that. Whether or not you are able to have that funded, it's worthwhile. It's not a huge amount of money, and you can kind of rag rate it a little bit in terms of which schools need decarbonisation plans sooner than others. Prioritise the least energy efficiency schools, as I say, rag rating them. Be strategic. Don't just go, oh, well, we need some LED. Yes, you do need LED, you do need solar and things like that, but think about your building envelope. There's little point in putting LED and solar into your buildings if, you know, all of the heat is escaping out of the roof or all of the heat is escaping out of the windows. Make sure the heat's not escaping first, and then look at what else you can do and get help. Don't try and go it alone. It's a very, very complex set of situations, decarbonisation planning. So it's a really good idea just to ask for help on it. A lot of the time, the costs will be kind of taken up by the amount of savings that you'll make from decarbonisation. So it's a good investment to do it. Next slide, please.
Oh, too far. Back one. Thank you. So Eddisons support for academies. We've got extensive track records with helping in the education sector across the board, and we can help with your estate management and help compile documents and for the plans, condition improvement fund applications, so all the SIF applications. We've got a very good success rate for SIF applications. And also SCA, school condition allocations, advice and capital works for those as well. And then also project management. So we've got good experience in managing projects from sort of startup right through to completion. And many of those are SIF projects, and we can help design those and oversee those so that they come in within budget and to make sure that works are completed to a high level. We've also got in-house architects and offer architectural services. Most recently, we've just done some project work and designing for T-level bids locally within the Hampshire area, and our architects were involved in the planning and design sort of process with those. We can also help with decarbonisation planning, funding and delivery, as Jenny has just said. Valuations, so the Red Book valuations, as previously mentioned. We've got RICS registered valuers in our South Coast offices and nationally as well. So we've got people on hand there to come out if necessary. Planned preventative maintenance. As building surveyors, it's something that we do on a very regular basis. And we've already spoken about the condition surveys, but they just help with making sure that you're budgeting correctly for the future and prioritising the correct areas. And then finally, also the identification of alternative funding streams in case there's any that you're not aware of or that are slightly more difficult or complex to get hold of. We can help to identify those and see what will help with your trust. So a couple of facts on the side there as well, so you can have a read of those. And on to the next slide, please. So just finally, we've achieved over £400,000 of funding for low carbon skills and decarbonisation planning. So we are experienced in this area as well. And finally, back to Jenny for the last one.
Yeah, so we're pretty much done there. We've whipped through things quite quickly. So if you do need any more information or you've got any questions outside of this session, then either Annabelle or myself or any of the Eddisons team actually are more than happy to help you out with those questions. We do have quite a number of our surveyors actually within our team are either trustees or governors within multi-academy trusts, so they can come at it from both levels. They understand where you're coming from as well as where we're coming from, so hopefully that kind of gives you some reassurance that they really get the education market. But thank you very much for inviting us today. It's been a pleasure to speak to you. Any questions?
Well, thank you very much, Jenny and Annabelle. If we have any questions, they'll come up in the chat boxes, or we can answer them at the end. But thank you again for a very informative session.
You're welcome.
So just wanted to cover now the internal scrutiny side of academies. Throughout the year, we are asked to carry out usually 2 or 3 internal scrutiny visits for academy trusts, and then report back to the audit and risk, or the audit and resources board, on our findings. Thought it was worth just saying at this point, though, that not all internal scrutiny needs, or should be indeed, financial. There are many other areas to cover within academy schools and trusts. And you should think about those depending on what is happening in your trust at the time. So if you have a big building project ongoing, then maybe a health and safety review would be more appropriate in that year. Cyber is another area that could be looked at. And as we've heard from Eddisons, you might want to look at your estate review and look at your decarbonisation plan. And that, again, is all good internal scrutiny. And we've not heard yet from Kirsteen, but again, governance is one of the areas that comes up time and time again, in making sure that your governance processes and procedures are still fit for your academy as it changes and grows. Overall, though, you should make sure you plan the work on internal scrutiny to obtain best value for your trust. So I thought it was worth just covering some of the common areas that we've been asked to review. One of them is around controls surrounding payroll processing, this obviously being your largest cost, and an area where we have recently seen frauds. The other area is around controls on purchasing and procurement, again, to make sure best value is obtained, to make sure authorization is within limits, and checking the capital versus repairs element as well. Another common area is around monthly close down procedures and the quality of the management accounts that are presented to your board and the timeliness of these. Again, Alan touched on it earlier with the budget forecast return. Again, we are asked to report on the preparation procedures going into your budget forecast returns, and how thorough it is and how informed it is. Where have you got the information to make sure that your budget forecast is realistic? And then reviewing the controls that you have within your trust to help prevent fraud, which is sadly still increasing in that area. So the common issues we find when we undertake these reviews, often we find that there are adequate processes in place, but they're not always being completed in line with the Academy's Financial Procedures Manual. And this mainly is in the area of payroll and procurement. So we recommend that you have an annual review of your manual to make sure it is up to date, because things do change, people change, the systems change, your IT changes, and therefore that manual needs to reflect what is practically happening and to making sure that the controls still work. The other area that we find issues in is on the less significant balances on your balance sheets, and that these aren't regularly reviewed and reconciled. So we would recommend that you add that to your monthly close down procedures, and at least do that at least termly rather than monthly. Many of you won't be preparing prepayments and accruals on a monthly basis in the management accounts, and sometimes these figures can change significantly, particularly if you have some SIF funding in place and building works ongoing. The other area of issues is around fixed assets additions and the depreciation not being accounted for on a monthly basis. And I know that this is an area of contention, but it is required under the handbook. And then sometimes we find that management accounts don't include a cash flow report and forecast. And this is one of the good sort of KPIs seen as good practice, and becomes more and more crucial as funding is getting tighter and tighter and reserves are being eaten into. And then finally, the other area that we see quite a few issues around is when you change your financial systems, IT packages. We've had a couple of clients that have changed systems, and it's taken them absolutely months to resolve all their issues. So we recommend good planning, and don't underestimate the upheaval of changing your accounting system. It will take time of yourselves in the finance team and management. So there has been no new guidance in this internal scrutiny area recently, but we do think it's important that academies don't just focus on the financial side. You need to look at the areas that are being highlighted in your risk registers, and I hope that we've pointed out a few of those areas today. So finally, just to remind you that you must get your internal scrutiny reports done before the 31st of August, and that you need to report on the work that you've had done in your trustees report, and state how you've chosen your internal scrutineer and the areas that you've covered. Okay, I think that's myself covered. I will now hand over to Alan Davies, who will cover off the teachers' pension scheme.
Thanks, Michaela. So just a very quick update on the teachers' pensions end of year certificate for the year ended 31st of March 23. Firstly, the process for completion is very similar to last year. The deadline for submission of the unaudited certificate was on the 31st of May, so hopefully you all submitted your returns on time. Following the submission of that unaudited certificate, we now have until 30th of September to complete the audits and submit the audited certificate, which we submit directly to teachers' pensions. We've now started undertaking our audits for this year, so please send your information to me if you haven't done so already. At the start of last month, I sent out details of the information required for the audits. Please let me know if you didn't receive this and I'll send a copy on to you. So just looking at our audit process, that's unchanged from last year, and again there are no changes to either the teachers' pensions submission arrangements or to the actual certificate itself. As I mentioned, we have started work on our certificate audits already this year, and so far there haven't been any new issues arising. Finally, in case you weren't aware, in terms of getting the information to us, we do have an online file exchange, which is a secure way of transferring sensitive information such as payroll reports. Please let me know if you'd like details of this and I can set you up with a login to the system. So I think that's just about it. Just a very quick update. Please let me know in the chat if you've got any questions. And I'm now going to hand over to Kirsteen from Trethowans for an update on Academy governance.
Hi, thank you, Alan. Thank you very much for inviting me along. I'm a partner at Trethowans. I am specialised in advising charities and non-profits, and I've got a lot of experience advising academies on a variety of different conversions, transfers, and also ongoing governance arrangements. So today, this short talk is going to look at what you need to consider if you're looking at either updating your articles or your funding agreement. I'm also going to look very briefly at community benefit objects, what they are and why they're important, and also touch upon the composition of the Board of Trustees. It's going to be a little bit of a whistle-stop tour, but I hope to cover the key points. So looking at Articles of Association, first of all. So initially, why might you want to update your articles? There's a variety of reasons as to why you might want to do this. It might be that you have an older model version. The DfE might have asked you to do to update your articles, which could happen if perhaps you're bringing on a new academy or you're changing your funding agreement. They might ask you to make changes to bring you up to date with the current model. It might be that it's just a little bit out of date. You want to update, you want to get a bit more flexibility. You might want to benefit an increase in your trustees, a change in quorum. There's a variety of reasons as to why you might want to update your articles. And one thing I will just, before sort of diving in, I will just mention is obviously you do need to bear in mind, depending on the type of academy trust company you are, you might have to also liaise with, so for example, if you're a faith academy trust company, you might have to liaise with the diocese, and it might be that they ask you to update your articles for one reason or another. So if you've decided you do want to update your articles, the next slide looks at the steps to actually make those changes. So first of all, what I would say is make sure you follow any processes and policies that you have in place. And that will be on a sort of an academy trust by academy trust basis, but just make sure you're aware of if you have any policies that do directly relate to this. And then first of all, you're going to draft those articles. Look at the current DfE model. And actually, it's not been updated for quite some time. It's about 2 years old now. I think it's June 2021 is the current DfE model. But have a look and see what changes you want to make. You've got two options. You can either make a wholesale update, so you can effectively just adopt the current model if you don't already have it, or you can just update and change specific provisions. As to which is right for you will depend on the reason you're doing it, and what you're trying to achieve. One thing that you need to consider, though, is whether any unintended consequential amendments might be triggered if you are sort of making sort of just bespoke sort of changes. In connection with that, and it kind of leads on to the third point there, is bear in mind if you're doing a wholesale update, there are certain provisions within your articles that are classed as regulated provisions. Now, by this, I mean your charitable objects, any benefits to trustees or members, and your dissolution. You either need to replicate those exactly as is in your current articles, or if you are going to make any changes, because they are deemed a regulated provision, you would need to apply to the Charity Commission for consent. Now, obviously, academy trust companies are exempt charities, so your involvement with the Charity Commission is fairly limited, but this is one of these sort of niche circumstances where you might need to apply to the Charity Commission. So this is, as I say, leading on to, do you need any consent to make the changes you want to make to your articles? So if you are making these regulated changes, you need to make an application to the Charity Commission. It should be relatively straightforward because the DfE and the Charity Commission have agreed sort of around those provisions in the current model. So if you were just changing certain regulated provisions to bring in line with the current model, it's likely the Charity Commission will be quite a straightforward yes, providing their consent. But just bear in mind, the Charity Commission are extremely sort of like stretched on their workload at the moment. So it's slow. It's just something to factor in, that's an extra sort of time consideration you need to bear in mind. Do you need any other party's consent? So you might need the DfE's consent. There's two key reasons why you might need it. One is if you've got a really old set of articles, back sort of in the first couple of versions of the model articles, the DfE consent was required for any changes. They've since done away with that, but you do need to check your articles. The other reason you might need DfE consent is if you're making any changes to the way that your trustees are appointed, removed or resigned. If you make changes to those provisions, your master funding agreement requires that the DfE consents to those. So you just need to consider what changes you're making and whether or not that consent's required. I mentioned old set of articles sort of having this requirement for DfE consent. It might be that there's another third party that's required to consent to any changes to your articles. This is more likely to be relevant if you have, as I say, sort of faith academy trust company, so you have diocesan involvement, or perhaps if you have a sponsor. It's usually, not always, but it's usually Article 10 in your articles that will say whether or not you need that consent. So it's just worth bearing in mind if you need a third party's consent. And the other circumstances you might is if you're removing someone's right. So if you have a third party that has a power to appoint a trustee in your articles and you want to change that, as you are removing a right of theirs, you do need to seek their consent also. So you get your consent, everyone's approved and you're happy, and then you have to adopt the changes. Sorry, Michaela, I'm not quite there yet. You have to adopt the changes. You adopt them by a member's special resolution. It can either be in person at a general meeting or by a written resolution. And then once that's all passed, you complete your filings. You have to file the updated articles with both Companies House and the DfE. And it's also worth bearing in mind, if you're making any of these sort of regulated changes that I mentioned, you might have to file additional forms with Companies House. So, for example, if you change your objects, you also have to file a CC04. So then now moving on to the next slide, I wanted to touch briefly upon community benefit objects and what they are. Some Academy Trust companies have these, some don't. Historically, they used to be quite commonplace. They were included in a lot of Academy Trust companies that were set up, say, sort of 6 to 8 years ago, maybe, that it was quite commonplace. And they did at one point actually used to be in the DfE model. They're not in the DfE model any longer. If you wanted to include them and you were either making changes or setting up a new Academy Trust now, you would have to agree with the DfE to add these in. On the slide, I've included an example of what the community benefit object might look like, and it will normally appear as an Article 4B. Effectively, this is just secondary to your primary object being, of course, to run the academies within your Academy Trust company. This is a secondary object of sort of being available for the community to provide facilities, and often this means things like, if you've got sports facilities, you might hire them out in the evenings or the weekends to the community to use them. Now, why might a community benefit object be required? Why is it important? Why is it necessary? Ultimately, it comes down to whether or not you do these sort of hiring out to third parties and what effectively can be called trading. So on the next slide, I've included in very brief terms the different types of trading. So there's 4 key categories of trading for charities. Your first is your primary purpose trading. So this is your activity that directly relates to your object. So in this circumstances, running your academies. The second is ancillary purpose trading. So it might not be directly related to actually running your academies, but it's connected, it's ancillary to. So for example, if you're selling school uniforms or textbooks to your pupils, that is ancillary. You've also got beneficiary trading. So this could be a type of trading activity that's carried out by your beneficiaries. So you might have a community cafe that's run, so sort of staffed by pupils. There's a couple of different ways you can do that. And then finally, and this is what really matters in these circumstances, is your non-primary purpose trading. So this is trading that is not directly in furtherance of your purposes, but raises funds. So prime example here is you have sports facilities, or you might have a large grounds or halls that you hire out to third parties outside of school hours. And obviously this is really common practice. But if you do it, you need to make sure that you are aware of the thresholds and what you are permitted to do within your Academy Trust company. So looking at the next slide, I've put on there what it's called the small scale exemption. And this is a threshold of the amount of non-primary purpose trading that a charity can undertake within its charity. So if you have your gross income of over 320,000, the maximum amount that you can undertake is £80,000 worth of this sort of non-primary purpose trading. And it's important to note that actually this is within the Academy Trust company. So that will include, if you have multiple academies within your company, it's across all your academies. It's not per academy. That 80,000 is per the Academy Trust company. So it's collective. If you exceed this threshold and you don't have a community benefit object, so as I say, if you've got the community benefit object, then actually you've got this flexibility, because you're, if it's your community, if it's renting out to community, if you're doing other types of trading, you might need to reconsider. But if we're looking at hiring out facilities to the community outside of school hours, your community benefit object covers you. If you don't have that, then you need to consider whether or not you exceed that threshold. And if you do, what do you do about it? Well, in short, you either need to add that object or consider whether or not you want to hive that activity out to a separate trading subsidiary. And there's other reasons why, if you have a high level of trading, a trading subsidiary would be appropriate, because ultimately it ring fences the risk. So just very quickly moving on, I know our slides are back now. Funding agreements, I just want to touch very briefly on this, is like your articles, there might also be some circumstances where you want to update your funding agreements, either because the DfE have asked you, or you want to, and it might be because you're bringing new academies in. It might be that you're seeking consent to change your articles and they're linking the two, making significant changes, a variety of reasons. The process is set out on the slide there if you want to. So as I say, you agree what changes you want to make. It will be done by way of a deed of variation. If the changes are minimal, then you can probably just set out within the deed of variation what those changes are. So for example, if you're increasing your capacity, you could just literally put that there. If it's significant changes, if you're adopting a wholesale new sort of funding agreement, then it will be annexed to the deed of variation. If you need to consent to it, you execute the deed of variation. What I would emphasise in connection with you, if you are making changes to your funding agreement, make sure that all parties are clear what academies you are intending to make those changes to. So if you're bringing on a new academy and you need a new MFA, you need to check and agree with the DfE whether or not it's intended that MFA will apply to just the new academy and your existing academies are on the existing MFA, or if it's all of them. And it's quite commonplace for an academy trust company to have more than one master funding agreement in place, but it's just making sure you are aware and have that agreement and conversation as to, you know, whether or not you're changing all your funding agreements or just some of them. And I'm conscious of time, but just finally, the last slide, I just wanted to very briefly touch upon the composition of the Board of Trustees. You need to be aware of what it says in your articles, because ultimately that is what you have to comply with. The provisions dealing with your trustees is usually in Articles 45 to 79, and this will normally be your trustees that are appointed by the members. If appropriate, you might have a foundation or a sponsor, that might be a diocese, it might be a sponsor body that appoints trustees. You also have this provision, and the DfE are quite tight on this, that if you don't have at least 2 parent local governors on each local governing body, you should have 2 parent trustees on your board. So just make sure you're aware of that and you comply with it. Most articles, and certainly the model, says that no more than 1/3 of trustees can be employees of the Academy Trust Company. The DfE has, however, emphasised that generally their preference is that other than the CEO or the principal, they would rather there weren't employees on the board. But that's a preference as opposed to a strict requirement. But bear in mind what your articles say. You just need to make sure that you know what your composition is and you comply with it. And if it's not right, have a look at it and see if you need to change your articles to add that flexibility. And make sure that you manage any conflicts of interest on the board. And that's particularly important where you have staff trustees, just make sure that you deal with it appropriately. So I think that's pretty much my time. And I appreciate that is a bit of a whistle-stop tour. But if anyone does have any questions, my contact details will be on the slides. Please feel free to just get in touch if you have any queries. And now I think I'm handing over to Matt. So thank you very much.
Perfect. Thanks very much, Kirsteen. So last but not least on today's agenda, I'll be taking you through a brief update on investment policies. So, I mean, why have we included investment policies on today's agenda? Well, if it's not obvious, then since 2009 up until last year, interest rates have been historically low. However, the base rate increased to 4.5% last month, up from just 1% this time last year. And the market is expecting rates to rise to about 5% later this year before dropping back down. So there is certainly much more scope now than there used to be in terms of investing surplus cash to generate some much needed extra income. So in terms of the Academy Trust Handbook, the ATH, I'm sure we're all aware by now of the differences included between musts and shoulds. So in fact, up until 2013, rules surrounding investments within Academy Trusts were only a should, believe it or not. The AFH, as it was known then, from September 14, first introduced the relevant musts in relation to investments to what the Board of Trustees had to consider. So this has been subtly tweaked since, but broadly remains the same. So quick recap. So it currently reads, as the Board of Trustees may invest to further the Trust's charitable aims, but must ensure investment risk is properly managed. So when considering an investment, the Board must act within its powers to invest as described in its articles, have an investment policy to manage and track its financial exposure and ensure value for money, exercise care and skill in investment decisions, taking advice as appropriate from a professional advisor, ensure exposure to investment products is tightly controlled, so security of funds takes precedence over revenue maximisation, ensure investment decisions are in the Trust's best interests, and review the Trust investment and investment policy regularly. So it's vital, therefore, obviously, that all of the above factors are taken into consideration and documented as such within your Trust's investment policy. So what should it cover? So firstly, obviously, it clearly needs to comply with the ACH, but in terms of a few ideas, so state what the Trust's powers are in respect of investments included within its articles. Also confirm the general objective. So this could be the investment of surplus funds to obtain a superior return when compared to returns received from the main bank account. So thought would need to be taken in terms of what is deemed surplus. For example, ensuring immediate financial commitments such as payroll and supplier payments can still be met. Also, what the Trust's risk appetite is. So this would be low risk deposits with institutions that are both regulated by the FCA and have a strong credit rating. And also authorization limits. For example, CFO can invest up to an agreed amount, with the CEO or Board of Trustees having to approve investments above a certain level. There's also some very helpful guidance from the Charity Commission relating to investments, called CC14, which I'd highly recommend is reviewed in line with your Trust's investment policy. This CC14 confirms how charities invest so that they can further their charitable aims along with specific legal duties and decision-making processes attached to each. It also states how, if trustees have considered the relevant issues, taken advice where appropriate, and reached a reasonable decision, they are unlikely to be criticised for their decisions or adopting a particular investment policy. One other area which can be used by trusts is the use of investment platforms, which have various benefits compared to completing this on your own. So this is where the trust would have one account with one of these platforms, and then within this one account, various different investments can be made from within. So firstly, this means there's only one sign-up process, which reduces the admin burden, which can always be of help. Secondly, they claim to have enhanced rates from banks, which are not offered directly to clients, so this could result in higher returns and be deemed value for money. Thirdly, they track all their bank's credit ratings, which can be requested, so you, again, kind of have that one focal point where you can track and manage the credit ratings of the institutions where the trust has invested. As a quick example on how this could work, say you had 340,000 which you could invest on one of these platforms. This could then be invested and split into 4 pots of 85, which then receives the FSCS protection. Again, you can split that between different maturity terms. You've got a bit more flexibility over it for the trust. Of course, their service does come with a fee, so this must also be taken into account when deciding whether or not to invest separately or whether or not to use one of these platforms. In terms of remit then, so this really is kind of relating to ensuring that all relevant parties within the trust are clear as to what their responsibilities are, and that all are in agreement with the overall investment strategy of the trust to ensure that investment risk is properly managed. So an example could be, so the overarching responsibility lies with the Board of Trustees. However, the board may wish to delegate the monitoring of the investment policy to a subcommittee, for example, kind of finance and risk, who then may delegate further the operational day-to-day aspects of the policy to the finance team, or more specifically a CFO within a trust. And clearly all of this will be documented within the trust's policy accordingly. Moving on, so a quick recap on the accounting recognition criteria for investments, as this depends on the length of the term, so you're aware of how this will be treated within your year-end accounts. Firstly, as long as the investment is less than 3 months, then it will be included within the kind of cash at bank balance on the balance sheet. Secondly, if the investment is between 3 and 12 months, it would sit as an investment within current assets on the balance sheet. And lastly, any investment of more than 12 months would sit as an investment within non-current assets on the balance sheet. So again, this should be taken into account when deciding on the maturity terms. in case any issues could arise from the investment balance being separated from the bank within your financial statements. And finally, just to finish on, we do have a template investment policy, which will circulate next week, which covers all the mandatory aspects. So would be more than happy to share this with anyone interested in seeing the template. It could be used as a starting point for a trust or a new trust without a policy, or simply compared against your current policy to ensure all relevant aspects have been covered. So, of course, as always, if anyone has any queries following today's forum, please do get in touch. Thanks very much. And now back to Michaela. Thank you.
Lovely. Thank you very much, Matt. We hope today you have picked up some points from the sort of wide-ranging topics that we've updated you all on, and I hope they've been relevant to many of your trusts. If you would like to sign up for our monthly Academy e-newswire, then please do drop us an email to request this, and also we'd be happy to hear of any topics you'd like to know more about, or indeed for future forums. We've not yet set the forum dates for 2024, so do watch out. It will be in the newswire and it will be on our website, and we intend to have a mix of in-person and online events again following your feedback. There is one final update that we are doing for your chairs of trustees and chairs of finance committee committees, which is on the 7th of September in the evening, because that usually fits in best with trustees, and that can be booked on our website, and I know many of your trustees are already booked on with us, and again that will be a run through on things that are relevant to them for the forthcoming audit season. So that just leaves me to say thanks to you all for attending today, and thanks to the HWB speakers, and a special thank you to Kirsteen, Jenny and Annabelle, our external speakers. Next week we will send out the slides, the recording and links and documents that we've promised, which will be the fact sheet on the Academy Accounts Direction and the investment policy template that Matt mentioned. And then again, you can send those emails and links on to anybody in your Academy Trust. We want to be as helpful as we can to share the knowledge. So it just leaves me to say I wish you all a good rest of the week, and hope you have a fantastic summer. Thank you. Goodbye.